Hello, and welcome back to your series of videos on adjusting entries. For this video, we are going to go over how to do the first type of adjusting entry. And before I show you how to do the first adjusting entry, let me briefly explain to you what adjusting entries are. So far, we have been working our way through the accounting cycle after the first trial balance. So far we've went through analyzing transactions, journalizing transactions, posting to ledger or T accounts, and then the first trial balance, right? So after that first trial balance, the next step of the cycle is adjusting entries. And the main point of adjusting entries, these are entries that you would do probably at the very end of an accounting cycle, usually the last day. And the point of them is to make sure that everything that happened in the time period that we're reporting for is properly recorded. Remember from the last video, we're trying to follow the rules for accrual accounting and follow GAAP rules that say that we have to report things, specifically revenue and expenses, have to be reported in the time period where the event actually happened, right? So there are four different types of adjusting entries, and I'm going to go through and make a different video for all of these. The first one, and the one that we're going to go over in this video, is converting assets to expenses. And there are three major examples of how we can do that. And I'm just going to go through each one of the three. And let me say, one of the things that makes studying adjusting entries easier is understanding that there really is only so many things you can do. It's not as infinitely like open-ended as just normal journal entries would be. There's the four types, and each type really only has a few examples. So if you can structure your notes along the same lines as what I'm doing, you'll have an example of pretty much every type you'll ever see. Okay, so the main point of converting assets to expenses for all three of these different examples is all of these things come from something that we've previously purchased, and as soon as we either use them or time passes that signifies us using them, we have to basically convert them from assets, meaning things we still have. We have to convert them from that to expenses to show that now we've actually used them, right? Let's start by talking about supplies. And so far, hopefully, you have at least noticed that there are two accounts that we've been working with that are called supplies. There's the main supplies account, right? That's an asset, it's all the supplies we have put into an account. And then we also have something called supplies expense that would obviously go on the income statement because it's an expense. And it's a little bit confusing to know, what the difference is between supplies and supplies expense. But basically, the asset account is supplies we have not used up yet, and supplies expense is what it becomes once we've actually used them up. So let's make an example. Let's say that on January 1st, we purchased supplies, and we'll say we did it with cash. So I'm just going to make the journal entries. Let's say that we spent $1,000 on these supplies. Okay. So pretty basic, same stuff we did in previous chapters, just journalizing, supplies going up, cash going down. Okay. So we enter this in our computer system January 1st. We go on about our lives. January 31st comes around, and we have our financial statements for the month of January that we need to now produce, right? And on those financial statements, the income statement specifically, we want to be able to show how much of those $1,000 worth of supplies have we used up during January. And then our balance sheet, since that's where assets go, would show us how many supplies do we have left. Right now, our computer system still thinks that we have $1,000 worth, right? Because we haven't done anything to change this since we made this first journal entry, right? So if we had followed through and made a T account for supplies, for example, we would still have a debit of $1,000. But let's say that you keep all these supplies in a closet and you go to the closet and you physically count what's in there, and you realize that you still have $300 worth left, but the other $700 worth of supplies you've now used up. Okay. So you really need your balance sheet account to show that you have $300 left, right? And we need supplies expense to show that we've used $700. And right now, we still have 1,000 on paper, right? And we don't have anything in supplies expense. So the way that adjusting entry would look is this. Line that up perfectly with the cash. Okay. So by doing this, we're recognizing that $700 worth of the supplies we had here has been used, right? So I'm going to put it in supplies expense to show that it's been used, and then my supplies account is going down by 700. So what this does is whenever I make an income statement at the end of January, I'll have $700 for supplies expense on there. And then my balance sheet, by lowering this by 700, now my balance sheet would show 300 as supplies, right? So see how this is basically, it's literally adjusting, right? An adjusting entry is literally just taking something that we need to change and adjusting it to be more accurate with what we've actually done in the time period. Okay, let's go on and talk about prepaid expenses. These are extremely similar to supplies, and the way we do them is honestly about identical. Most of the examples you'll see here are things like rent and insurance. Like, I think on your homework, the very first question is something about unexpired insurance or prepaid insurance. So let's say on January 1st again, and I know I'm going out of order with the dates, but it's okay. Let's say that we decided that we wanted to prepay for an entire year of insurance expense all at once. And maybe we normally spend $100 a month on insurance. So if we were going to pay that for a year, it would be $1,200, right? 100 times 12. So whenever we first buy that, it would look something like this. We could call it something like unexpired insurance. We could also just call it prepaid insurance. This is something that doesn't have like a set title. It kind of depends on what the company calls it. But we're going to increase this, and then cash will obviously go down because we spent cash on it, right? This is an asset account. Even if you see the word expense on it, if it's a prepaid expense, I know that's confusing because you'd think it's an expense because it says the word expense, but anything that's prepaid like that, we consider it an asset. So if we were to make a balance sheet that second, we have unexpired insurance listed on the asset section, $1,200. Okay, so after we journalize that, we are going to assume that time has passed, right? Let's say that the entire, well, let's see. Let's just do it for January 31st again, okay? So let's say January 31st comes by and we have to figure out a way to show, very similarly to what we did for supplies, we need to figure out a way to show that now we technically only have $1,100 left in unexpired insurance. Because if we paid for an entire year and it's $100 a month normally, now that January has gone, we've basically used up $100 of that, right? Because the time period we paid for has went by. So we need to figure out a way to get that to 1100, and on our income statement, we need to figure out a way to show that we have insurance expense $100, right? So, very similarly to what we do there, we're going to increase that expense account first by the amount used up, and we're going to lower the asset account by the amount used up. Okay, so now our income statement would have insurance expense $100, and our asset account would show $1,100, right? Because we took 100 out of the original 1,200. So see, you're literally doing the same thing for both of these, for supplies and for anything that's a prepaid expense. So just to summarize the steps really quick, and I'll actually write the steps out over here. So, steps for converting assets to expenses. The first step is to record the initial purchase, right? If it's not already done for you. Some of the homework assignment questions, they might already have this and then tell you how much has been used up and want you to do the second part, right? So that's kind of sometimes you do, sometimes you don't thing. Okay, but then the next step, whenever you actually make the adjusting entry, you know what? Let's just do that. So let's assume that obviously let's make this the steps for actually making the adjusting entry. So obviously you would have to record the initial purchase if it hasn't already been done. But for the adjusting entry, the first step is to debit the expense account, whatever the appropriate expense account is, whether it's supplies expense, insurance expense. Rent expense is another one that you'll see prepaid a lot. Very similarly, like if you had monthly rent and you wanted to pay for a whole year in advance. But whatever the expense account is, you first debit that and then you credit the asset account, okay, which lowers the asset account. All right. And both of these amounts are either increased or lowered by the amount used up. All right. Because we're trying to convert the asset we have to an expense to show that now we no longer have an asset, we have used it and it's become an expense. Assets are basically things that you're going to use in the future that you have not yet used, right? It's future things that you're going to use. Expenses are in the current period, we have used this, right? All right, but that is it for those two. And I think this video is already kind of long, so I'll actually do a part two for this and talk about depreciation separately.